The following script was written, verified, and approved by compliance professionals. A registered investment advisor, or RIA, is a firm or individual registered with the SEC or state regulators to provide investment advice for compensation. Established under the Investment Advisors Act of 1940, RIAs are bound by a fiduciary duty to act in their clients' best interests at all times. This framework defines an investment advisor through three conjunctive elements: providing securities advice, being in the business of doing so, and receiving compensation for these specific activities. The 1940 Act remains the governing statute, granting regulators comprehensive enforcement authority over the advisory relationship and registration requirements. The Dodd-Frank Act restructured registration thresholds based on regulatory assets under management, or AUM, dividing firms into categories based on size. Large advisors managing at least $100 million are eligible for SEC registration, which becomes mandatory at the $110 million threshold. Mid-size advisors, managing between $25 and $100 million, generally register with state authorities in the state where they maintain their principal office. Small advisors managing below $25 million register with and are regulated by state securities administrators under the State Investment Advisor Registration Framework established by the Uniform Securities Act and implemented through state law in each jurisdiction. This regulatory AUM includes the market value of all securities portfolios receiving continuous and regular management, ensuring oversight scales with the firm's reach. Advisors must monitor these levels annually, filing updates to their registration status if their managed assets cross the designated federal or state thresholds. This tiered structure ensures that federal resources are focused on the largest firms, while state regulators provide localized oversight for smaller advisory practices. Transparency is mandated through Form ADV, the uniform application for registration and disclosure used by both federal and state-registered investment advisors. Part 1 contains organizational data, ownership structure, and disciplinary history, filed electronically for public access through the Investment Advisor Registration Depository, or IARD. Part 2 serves as the narrative brochure delivered to clients, written in plain English, to describe the firm's services, fees, and potential conflicts of interest. It must detail methods of analysis, investment strategies, and brokerage practices, including any soft dollar arrangements that might influence the advisor's recommendations. Advisors must deliver this brochure at or before the start of an advisory agreement and provide annual updates to existing clients within 120 days. The annual updating amendment, filed within 90 days of the fiscal year end, is also when the advisor reevaluates its AUM and registration status. These disclosure mandates ensure that clients remain fully informed of the firm's operational boundaries, fee structures, and disciplinary history throughout the advisory relationship. The RIA framework is anchored by the fiduciary duty, which flows from the anti-fraud provisions of the Investment Advisors Act of 1940. This defining obligation comprises two central components that apply to the entire advisory relationship: the duty of care and the duty of loyalty. The duty of care requires providing advice in the client's best interest based on a reasonable understanding of their specific objectives and risk tolerance. The duty of loyalty demands the elimination or full disclosure of all material conflicts of interest that could compromise the objectivity of the advisor's guidance. Rule 206(4-7) requires firms to implement written compliance policies, designate a chief compliance officer, and conduct thorough annual reviews of their effectiveness. These internal controls, alongside rigorous records retention cycles, form the backbone of regulatory supervision and enforcement by the SEC and state administrators. In summary, the RIA model prioritizes fiduciary responsibility, structured registration thresholds, and comprehensive disclosure through the Form ADV framework. Understanding these statutory requirements is essential for anyone seeking professional qualification in the financial industry or navigating regulatory compliance. Knowledge gets you qualified. Visibility gets you hired. Explore financialregulationcourses.com for professional memberships that combine verified profiles, QR code resumes, and intelligent career tools. Designed to help ambitious finance professionals stand out long before the interview begins. Thank you for watching.